Yeah, hold up, wait a minute, let's make this right. You the only...
All right. Hi, everyone. Once again, welcome to this evening's session on S-REITs. My name is Jason, and I'm part of the advisory team here at Syfe. And I'm very excited tonight to host you with what is certainly a very strong panel lineup. So before we begin, some administrative matters. All right. If you can see on the screen behind me, there's a QR code. All right. If I can trouble everyone to take out your phones and just scan the QR code. All right, so this QR code is very important tonight. It will be your main form of interaction with us this evening, all right, for those who are present as well as those who are online. All right, so if you scan it, you will see that there are two main sections, right, the poll questions, pre-session and mid-session, all right, and also the Q&A. So for Q&A, of course, if you have questions that you'd like to ask the speakers, all right, please post it on there. For the poll questions, if I can trouble everyone to fill up the pre-session poll right now, that would be great. Right, for those who are physically present, you may also approach the panelists after the session and have a quick chat with them also. All right, so onto the session proper. If you recall, last year in March, we actually kicked off our S-REITs focus session with a very strong bullish start to the first quarter. However, since then, the landscape for the S-REITs has faced significant shifts, both upwards and downwards. Despite this, retail investors have continued to invest in the S-REITs, capitalizing on valuations below long-term averages and attractive yields. Even institutional investors who were net sellers this year, they have now become net buyers of S-REITs. So the question begets, are we on the cusp of a turning point? And this evening, we have invited distinguished speakers from Lion Global and SGX, respectively, who will share with us their insights over this 90-minute session. Before I introduce the speakers, let me just briefly share the agenda. So first up, we'll have a market outlook by Toche from Lion Global. Then Emilia from SGX will share a few highlights and outlooks. And finally, Ritesh from Syfe will share how to invest in S-REITs. And we'll end it off with a Q&A, followed by some refreshments and networking. So our first speaker today, his name is Toche, co-head of fixed income team at Lion Global Investors. He has a wealth of experience in the Asian fixed income markets. Fun fact, he was also present at the launch of our Syfe Cash Plus 3 years ago. Today, it is known as the Cash Plus Flexi portfolio. Next up, Emilia Tan, SGX. She's a director and founding member of the research and FinLit team at SGX. For those of you who are unfamiliar with what FinLit is, it's a good chance for you to find out. Right. With more than 9 years of experience, she brings to the table a broad breadth of investor knowledge. I spoke with her earlier during the session, and she loves real estate. So I think it's very apt for today's session. And last but certainly not least, Ritesh, Managing Director and Head of Investment and Advisory at Syfe. He's an established veteran of our online webinars and physical sessions for Syfe. So internally, I can share with you that he's also known as Ritesh, as in R-E-I-T-Esh. All right. So, benefit for those of you who are joining us for the first time this evening, please allow me to give you a quick 2-minute introduction about Syfe. So Syfe, we are a digital investment platform, all right, and we seek to empower our clients to build their wealth for a better future. We are headquartered here in Singapore, and we are MAS licensed as well. We have a mobile-first approach, right, where our managed portfolios, our cash management solutions, and our brokerage platforms, they are all accessible within the same app itself. And this allows our clients to invest in a very holistic and a very seamless manner. The advisory team then adds on that additional layer of support and guidance on top of it. We are trusted by over 100,000 users here in Singapore. All right, and here's a quick snapshot of our journey to date. So we launched in Singapore in July 2019. We've gone through several significant milestones in a very short span of time. Especially in 2023, we've introduced our Income Plus portfolio, powered by PIMCO, and we've also further augmented our cash management solutions with Cash Plus Guarantee as well. All right, without further ado, I'm very excited to welcome Toh Chieh, our first speaker, who will give us a market outlook. Toh Chieh, please.
All right, thank you, Jason. A very good evening, ladies and gentlemen. My name is Toh Chieh. I am I'm the co-head of fixed income at Lion Global. For those who are not familiar, we are part of the OCBC group. OCBC, we're also owned by Great Eastern. And Great Eastern being a large insurance company, we manage their public securities, and therefore we do manage a large book of bonds or fixed income. But today I'm not here to sell any bond funds, right? But the fact that we are managing a large book of bonds, in bond markets, we have to watch interest rates carefully, and therefore the correlation is important, right? Because if you're looking at REITs, interest rates is a key part of your investments. So today I'm going to talk a bit about where the market is from a fixed income fund manager's perspective. How do we see the bond market? And as you know, bond market is driven largely by the US interest rate market. So I'll start off by talking about the US interest rate market. So on this chart, you can see the black area on the right. The two lines there, right? The yellow line is the inflation number. We call it the core PCE. This is the inflation number that the Fed chair looks at. And the blue line is the Fed funds rate. And you can see big spike up in inflation post-COVID, right? As you know, when COVID, or rather when economies reopen after COVID, people rush out, you spend things, services, you travel. And as a result, because the economies were not ready, inflation spiked up. And Fed had to respond. You look at the blue line, they had to hike more than 5%. I think most of you will know this. But the key thing is, the yellow line, core PCE, is now coming down, right? Fed's target is 2%. Right now, we're at 2.6. Now, you don't have to wait for the inflation to hit 2% before Fed cut, right? Because there's a lag between monetary policy or interest rates to the economic cycle or to inflation. So Fed has to cut before interest rate hits 2%. You can see that it's obviously heading towards that way. So as a result, market is now getting excited that market is pricing in Fed cuts. And one way of looking at that is to look at the dot plot. This is the interest rate, or rather the Fed fund amount of cut which the Fed committee estimates. And this was taken in June, right? And if you just look at the green line, that is the dot plot, we call that. The green line is the average of the dot which the committee members estimate. Based on this, in June, the Fed estimate that they'll cut once in 2024 and another 4 times in 2025. Now, fast forward to today, because we have a recent good print on CPI, plus the fact that the recent employment numbers are getting weaker, Fed therefore has to cut more than once, as telegraphed in their June meeting. So right now, the market is pricing in a bit more than 2 cuts for this year and 4 cuts next year. Now, I just want to show you the yield curve. This is the US yield curve. The darker line on top is where we are today, or rather in June. The bottom line is the yield curve as of February 2022. So 2 key takeaways. Obviously, one is right now, interest rate is a lot higher. Second part is that the yield curve currently is inverted, meaning short-dated interest rates is higher, and as you go further out, interest rate starts to drop. Now, the fact that rates have gone up a lot, and this is since 2022, and you guys know that, right? Because interest rates today is a lot higher. If I could make a reference to the REITs market, now obviously REITs react negatively to rise in interest rates. So this tells you, or rather this gives you a perspective of how much rates have gone up. Now, rates aren't going to go back to where we were in 2022. That's too much. But at least having lived through what the REITs suffered in the last 2 years, this gives you that estimate of what kind of impact you have based on the rates movement. So first of all, rates aren't going to come down to those levels. Later on, I'll talk about the risk of interest rate going up, but this gives you the perspective. Now, this move is 2%, 200 basis points, okay? This is to set things in context. If I were to tell you later that rates could go up, it's not going to go up by this magnitude, okay? So you have a sense of where your downside risk is, okay, having lived through the last 2 years. The inversion of the curve also tells you something, which I'll elaborate a bit later. But I'm trying to move back to the Singapore market shortly. But before that, I'll just give you a quick outlook of where we see interest rates. So I've already mentioned Fed is on track to cut 2 times, each time 25 basis points. So 50 basis points by this year. And this is because recent data has shown that inflation has come down. On top of that, employment situation looks to be weaker. Right now, Fed has 2 mandates. One is to have a price stability, meaning inflation cannot be too high. And secondly, to have maximum employment. Right? So if employment is going down, meaning if unemployment, or more people are losing their jobs, they have to act. If they keep rates at current high levels, there'll be more job losses, and that's not their mandate. Now, the last point is pretty important here. We all know that what's happening to election in the US, right? You saw what happened over the weekend when Donald Trump got shot, and that famous picture is going to be very significant in this campaign. Therefore, there's a risk that you get a Republican sweep, meaning they win the presidential election, they get the House and the Senate. When this happens, then Trump can go ahead with his policies, right? He's going to cut taxes, he's going to spend a lot, he's going to cut down on immigration, and obviously he's going to put on tariffs. Now, all these are inflationary, okay? So here's the key thing. From now to end of the year, I mentioned Fed can cut twice, unlikely to cut twice. Now, at this point, nobody knows, right? Neither does the Fed know who will win the election. If we do get a Republican sweep, the risk of rates from then onwards would be that interest rate could go up. So that is our concern for the bond market. Now, this is on the long end of the curve. Okay, remember the yield curve? So when I say long end, probably 5 years and above, right? The short end rates will still come down because Fed is going to cut. What is also unknown is you have Fed wanting to cut rates, but Trump coming in. At that point in time, would the Fed listen to Donald Trump? Now, all Fed chairs will say they are independent, and we will always hear that. The question is, when they act, do they really have this pressure from Trump? That's an unknown. Trump was recently quoted that, he likes Jerome Powell, provided he does the right thing, right? So now, what is the right thing? That depends on or rather, Trump's definition of right thing is very different from what economists believe. Okay, so that's pretty much our view on interest rates. So the last point is a concern about higher interest rates down the road. Now, remember I told you that, I showed you the magnitude of this move to put things in context. And when we say that there's a risk of yields going up, it's probably in the range of between 25 to 75 basis points, right? I just want to set that context. So while I say that rates might go up, that is the potential range of rates going up, right? It's not going to be in this magnitude of what you've seen post-COVID, okay? Now, I also want to bring the context of interest rates to Singapore, right? Because we are talking about Singapore rates. What has US rates got to do with us? Now, so in Singapore, we don't have a Fed. We have MAS, central bank. The MAS doesn't move interest rates, right? Doesn't cut, doesn't high rate. Or rather, MAS manages the policy using the exchange rate. And this is the policy statement on the website. You can check it out. But the key point, or rather the key policy right now is they want to have the rate of appreciation of our policy back against the Singapore basket, against the trading basket. So in other words, the Sing is expected to appreciate at a certain rate against the trading partners. Now, if you were to pretend that just for illustration, if our trading partner is just the US, right? If current policy is roughly 1.5 to 2% appreciation, now if Sing, your currency, our currency Sing, is expected to appreciate 1.5 against US dollars, it will mean that our interest rates has to be lower by that amount for us to have interest rate parity, right? Or in other words, no free lunch. Okay, because if your appreciation is at 1.5, your rates has to be compensated by the same magnitude, right? Now, this brings us to the Sing curve. So remember, this is the US curve, and if I say that Sing is roughly 1.5% lower, you can kind of draw a line to say that the Singapore curve is roughly 1.5%. Now, my 1.5 is a rough estimate because this policy is not written in MAS policy, right? The guys like us, we have to guess what the slope is. And based on the different literature published, it's roughly 1.5%. So what I'm trying to get at is this white colored dot, right? That is the Sing curve. Okay, so the white line is where the market is today. Okay, there are 3 dots out there. Those are our funds, which I promised that I will not talk about. So I've got our money market fund, enhanced liquidity, and short duration bond fund. Okay, so back to the Sing curve. Right now, our Sing curve is also up, inverted, meaning downward sloping. Now, mathematically, if you were to ask yourself what is the rate in 6 months' time, that's where you get the blue line. And this is just based on mathematics, nothing to do with our view, well, it's actually the market's view. That's where the line is in 6 months' time, and in 12 months' time, that's the orange line. Okay, so currently, market is saying that rates, the yield curve will look like that in 6 and 12 months' time. So this is to give you a perspective of where rates are, given the yield curve, the fact that it's inverted. Now, I need to highlight one thing. Market is notoriously indecisive, right? Things can change very quickly. Look at what happened over the weekend when Trump got shot, right? So this is not exactly a prediction. It's just saying that today, based on what's available out there, this is the interest rates outlook given by the market. So that's pretty much what I have now. I was just trying to bring the US curve to Sing, because as Singapore investors, we are concerned about where to put our Sing dollar, right? Whether you want to put into short-term deposits, equity, REITs. The very short end, for example, you know that you buy your T-bills, today it's below 3.7. The very short end is a 3-month MAS bills that institutions can invest in. It's around 3.8 today, but we think that it will drop because yield curve is inverted and because Fed is going to cut. So we think that short end rates will drop. For longer tenor, the inverted yield curve tells you that it's dropping, but with one big caveat, right? Whether Trump will get a Republican sweep. With that, I end my presentation. Thank you.
All right, thank you, Toh Chia. Next up, I'd like to invite Emilia from SGX, who will give us a highlight and outlook of the Singapore REITs market. Emilia, please.
Hi, everyone. Let me maybe use the mic. Hi. Okay. Evening, everybody. Thanks for coming all the way down. I'm Amelia from the SGX research team. Jason mentioned earlier that I do love real estate, but don't have so much money, so REITs is a good way to get exposure into real estate. Okay, I'll give you, today's session is just to talk about where REITs are today and what's next potentially in terms of for the sort of second half of this year ahead. First and foremost, a bit of a recap of the Singapore market. The Singapore benchmark, STI, has generated competitive returns amidst a very challenging global environment. As of end 2019, through COVID period, all the way until now, STI is actually up 25% on a total return basis. As of today, actually, I think it's up closer to 30% because my numbers are as of end of June this year. A lot of the returns over here much driven by banks, because the three banks have averaged 70% total returns from the same period until today. So STI has generated competitive returns. We have also outperformed some of the ASEAN markets, regional markets, in line with some of the returns. From a fund flow perspective, right, over the last 4 years, retail investors have been net buyers of the Singapore market. They have been net buying over 15 billion worth of stocks in the Singapore market, perhaps also taking the opportunity to pick up a bit more along the way, because we noted that at times when the STI is perhaps compared to some of the regional indices not doing so well, retail tends to come in, perhaps picking up opportunities. So this year, right, last year Singapore saw GDP at about 1.1%. This year GDP is expected to double, expected say 1 to 3% in terms of the 2024 figure. Despite that, we know global challenges still remain. Right, a lot of countries this year are actually going to the elections, to the polls. This year is the year of the election, so a lot of attention will be on the various countries and how that will impact the stock market, right? And perhaps that's also a reason why gold as a safe haven asset has more than doubled the STI returns from the same period, up 52%. Now, we talked about interest rates earlier on, right? And interest rates, we know, do impact the REIT sector in a few ways, right? Actually, there are 3 ways that REITs could impact the REIT sector. Number 1, it could affect financing costs. It becomes more expensive for them. And when it's more expensive, potentially it could also impact REITs distributions. And third, it could also then impact the property valuations and hence maybe overall less attractiveness for investors. Now this chart over here, what I've taken a look at is the dark blue line. That is the IH S-REIT index, which measures the REIT performance. The dotted line were the interest rate cut expectations for the March as well as the May meeting. So I'll walk you through a little bit. Last quarter, from October onwards all the way to December, recall what did Fed do? Fed indicated that potentially they will hold rates steady, right? And that saw REITs rally in the last quarter. Global REITs rallied. Global REITs, I think they rallied about 15%. S-REITs rallied end of last year up 20%. Rallied all the way until January, where the expectations started to ease. So REITs have also then started to trace back this year. And that's why this year, on a year-to-date basis, our REITs are down about 6% because of the interest rate expectations, right? And the chart on the right-hand side, this is actually available online. If you Google CME Fed Watch tool, this is a tool that tells you, right, what are some of the interest rate expectations or where interest rates could be. So if you look at the blue shaded boxes, what this shows is that interest rate expected to cut sometime at the end of this year, especially in the 4th quarter of this year. And if you go to CME Fed Watch tool as of today, the expectations for a rate cut at the upcoming September meeting is over 90%. And if you look at for the other meetings towards the end of this year, December and also January next year, expectations of a rate cut is almost 100%, right? So market is expecting Fed to cut rates towards the end of this year or early next year. Now, just a slight recap in terms of what has happened in our sector so far. Okay, in March, Fraser Centrepoint Trust entered the index. Now within the STI, we've got 7 REITs with a combined weight of about 13%. Right? Some bright spots in the market: hospitality REITs, their distributions for 2023 was up 20%. And with interest rates, the talk is always, okay, how about acquisitions? Maybe it will slow down because of financing costs going up, right? We've also noted this year, a number of our REITs have also started to undertake acquisitions, so the activity is also coming back. This slide, I have taken this from NAREIT, which is the US REIT Association. This chart actually shows the dark blue line, all equity REITs, so global REITs. The light blue line is the 10-year US Treasury yield. So what this slide really shows, at the end of the day, we're trying to bring out the point that interest rates directly correlate with the returns for REITs in terms of the performance, right? Since 2022, or rather end 2021, up till last quarter, the 10-year Treasury rates were up 332 basis points. At the same time, REITs performance down 30%. Last quarter, right, 10-year Treasury yields were up about 102 basis points. Global REITs rallied up about 20%. And this year, 10-year Treasury yields increased by another 30 bips. REITs are also down 1.3%. So there's very high correlation with the interest rates. That's one thing to note from this. This slide I've also taken from REIT, right? The point of this slide, it talks about how REITs will the study has actually showed that REITs tend to perform at the end of rate raising cycles. So the REIT Association, they are relatively positive that REITs will recover next year. And when you see this chart over here, this chart shows that during Fed tightening cycles, the public real estate, private real estate, and also the equity markets tend to underperform. But 4 quarters after the Fed tightening cycle is over, the different asset classes tend to outperform. And in fact, the dark blue chart, which is the public real estate, tends to outperform the private real estate as well as some of the other equity markets. So what we saw in last quarter could signal that when there are monetary policy sort of adjustments, that could also herald in REIT outperformance later on. And the REIT Association has also noted that the moment Fed starts to cut the rates, it could potentially see institutional investors pouring the funds back into this particular sector. Okay, now then we take a look at our own REIT sector, right? How do they look like in terms of the balance sheet? Are they healthy? How are they? Where are they standing? Our REITs today, we have 40 REITs. On average, the gearing ratio is about 38 to 39%. This is still well below the 50% regulatory limit that MAS has kept on REITs. So this means that there's also a potential headroom that they can undertake. 22 billion worth of potential debt headroom they can undertake if they want to take on more debt to do acquisitions, right? And you can see in the green line, about more than half of our REITs are actually, they have gearing ratios that are below the sector's average, okay? And for a lot of our REITs, close to 75% of them have actually hedged their debt into fixed rates. So with lower gearing ratio, and with also the debt hedged into fixed rates, REITs as a sector could be well positioned to ride through this high interest rate cycle. Don't worry, these slides actually are available on our quarterly REIT chart book. So you can actually go to our website or you can follow our SGX Invest Telegram channel to get some of this information. Okay, so this slide also just chimes in that REIT also agrees with this point that disciplined balance sheets will help REITs to insulate from higher rates. And what you can see is from 2008 onwards, REITs on average have maintained long-term and well-structured balance sheets with low leverage ratios. All right, then how do REITs look in terms of the valuation standpoint, right? There are 2 ways that investors typically will value REITs. Number 1, distribution yield. Number 2, the price-to-book ratios. Okay, so what is price-to-book ratio? Price-to-book ratio is really the share price versus the book value of what the asset is actually worth. So if a REIT has a high price-to-book ratio, it means that the investors actually value more than what the REIT's book value is actually worth. And if the REIT has a lower price-to-book value, it means that the investors are actually giving a discount or value it less than what the book value actually holds. Right, and if we take a look at this chart, this is what we have plotted, the S-REITs price-to-book ratio over the last few years, right? Where are our REITs trading at today? REITs are actually trading at a price-to-book ratio of about 0.7 to 0.8 times. Against the historical average, this is actually close to a 20% discount. Means investors are pricing REITs at a 20% discount to what the underlying property assets are actually worth. So for value investors, perhaps they may see this as an opportunity to pick up more. And maybe that is also why our retail fund flow into this particular sector this year is already close to $1 billion worth of net retail inflow. For the same period, first half of last year and the first half of the year before, net retail inflow was only close to about 300 million to 450 million. So this year you can see retail continues to net buy this sector, right? And on average, REITs typically will trade at book value, means 1.0 times. So if you see the chart, normally it trades at book or slightly above book value. And there are also shorter periods of time where REITs trade below the book value as opposed to above the book value, right? And if we look at some of the 10 largest REITs within the IHS REIT index, you can see that almost all of them, in fact, all of them are trading at discounts to their 5-year average price to book value, ranging from 6% discount up to 30% discount. Okay, so that's where REITs are today in terms of a valuation standpoint. This is another chart from our REIT chart book. This shows the yield spread. The yield spread on average typically is at about 400 basis points, but today the yield spread has also come off. We are closer to a yield spread of about 320 basis points. So investors, then they will have to decide for themselves, right, whether they want to put their money into something that pays them 6 to 7% dividend yields, or perhaps relatively safer instruments at about 3+% yield. And just a slight recap, our Singapore S-REITs market, we have 40 S-REITs. Combined market cap today is close to $90+ billion. This is about 12% of the overall stocks that we have listed on the exchange, but on a daily turnover, the daily turnover for the REIT market is very liquid. About a quarter of Singapore's overall liquidity belongs or comes from the REIT sector. Average dividend yield for this sector is about 7%. Average price to book, we talked about that earlier on, 0.7%, trading at 20% discount to its historical average. On the right, this shows you that REITs, our sector, 40 of them, they're very diversified. They're diversified across the different markets. They're also diversified across different subsegments. This is another chart from our REIT chart book. This shows that what we have done is we took a look at the different REIT subsegments and we broke down and lumped them together to see what is the average dividend yield for each of the sectors. So what you can see over here, based on our last chart book in April, office, diversified, and also hospitality REITs were some of the sectors that had one of the higher distribution yields. This chart shows our REIT market versus some of the global REIT markets. The point over here is that the S-REITs are one of the higher distribution yield markets, but in terms of a volatility, it is less or lower volatility compared to the other REIT markets. And then, why do investors invest in REITs, right? Because REITs give you exposure into real estate. They trade like a stock, but they have a characteristic of a fixed income because they pay out regular distributions, a bit like bonds. And you can invest into different property subsegments. Of course, some of the benefits will include diversification, right? If you buy a physical property, right, capital outlay is very high, and you can only buy that perhaps at one property. If you buy into a REIT, for example, they have different properties within the REIT subsegment, so there's diversification over here, right? Number two, tax efficient. For REITs, they are governed by certain regulations, and for every $100 worth of rental income, they must distribute 90%, or $90 must go back to investors, such that they don't pay tax at the REIT level. So very tax efficient, good for the shareholders. REITs, because they pay regular distributions, you look at it from a total return standpoint. There's price gain, there's also dividends. And of course, liquidity. You buy and sell like a stock. All right, this is the last slide from NAREIT I took over here to show that REITs are not just a retail product. Institutional investors are also heavily invested into REITs as well because of a few reasons. Number one, liquidity, very important fact. A few other facts would be as part of their asset allocation strategy. And another point is because you can, through REITs, get access into some of the emerging sectors and emerging markets. For example, data centers. You may not buy a whole data center, but you can actually invest into data center REITs, right? And lastly, we have 5 REIT ETFs. that are listed on the SGX. But of course, there is also the REIT Plus product, which I think that's the whole point of us being here tonight, which actually tracks the IHS REIT Leaders Index. So with that, hopefully it's a good roundup in terms of where we are of the sector, the valuations, prepping for when rate cuts, when Fed cuts rates at the end of this year, early next year, and also potentially how REITs look like in terms of their balance sheets. Are they well positioned for it? And also some of the retail fund flows that we've seen. So we'll probably be happy to address some of your questions later on. All right? Thank you.
All right, thank you very much, Emilia. Next up, we have Ritesh, who will show us a few ways of how you invest in S-REITs itself. Ritesh, please.
Hi everyone, thanks for joining in tonight. Very excited to see a full house. Thanks Toche and Emilia for covering the overall interest rate outlook as well as the outlook for the REITs market. Now, REITs is something which is very close to my heart. This was one of the first asset classes that we took a look at after we went live with our platform back in 2019. So we started with the launch of the Syfe REIT Plus portfolio back in 2020, and I'm proud to say that now our REIT Plus portfolio commands an asset size which is comparable to some of the biggest REIT ETFs in the market. So thank you for placing all the trust into our platform, and we will continue to make progress on our REIT strategies as we move forward. Now, why REITs, right? Of course, as Emilia also pointed out, REITs provide a unique combination of income and growth for investors. And that's why it is hugely popular, because as REITs are structured to give 90% of their profits as dividends to shareholders, that ensures that you get a very regular kind of payout in terms of dividends on an ongoing basis. So something which people really use as a constant kind of income generator for themselves. Also, because REITs are listed in the market, they trade and their prices should appreciate over time as the REIT portfolios expand as well. So you get the combination of growth plus income, which is very unique to REIT as an asset class because it kind of has characteristics of both the equity and the fixed income market, and with slightly lower correlation compared to the equity markets themselves. Now, obviously, it's been a bit tough if you look at the last few years for the REITs market, because the REITs market has been significantly impacted by kind of like a double whammy of sorts, right? We initially started off with the COVID pandemic, and that led to a huge amount of demand-related issues. But then as we moved into 2022 and last year, a lot of the REITs valuations, et cetera, were impacted because of the interest rate hikes, which was I think at the fastest pace that we have seen in decades, et cetera. And that really impacted the financing cost of REITs and led to a lot of corrections in the REIT market overall. So over the last 3 years, obviously it's been challenging. But again, as Toche and Emilia pointed out, we are now in a more certain environment that interest rates are going to come down, right? And with a September rate cut probability almost close to 100%. So with that backdrop in mind, and the fact that the interest rates coming down means your yield on cash instruments will start coming down as well. So what you have right now, if you're predominantly in cash instruments, it's actually a very good time to look at the REITs market, because the dividend yields are still very high, and the price to book ratio, which Emilia was pointing out, is very, very low, right? It's trading at one standard deviation below what the long-term average is. So now, of course, how do you invest into REITs, right? So today I will just cover a little bit about how do you get exposure to REITs, what are the typical ways for you to go about doing that, and then also talk a little bit about our Syfe REIT Plus strategy. So obviously, you can invest into REITs individually through a brokerage platform, so you can buy into individual REITs. If you want a diversified exposure, then you buy into REIT ETFs or funds, so then you get instant diversification. And then, of course, with the Syfe REIT Plus portfolio, you can get exposure to REITs, again, in a diversified manner, but even with more optimizations and efficiencies built in, which we'll go into later. Now, what are the pros and cons when it comes to investing into REITs on an individual basis? Of course, you have the control. So if you are investing into individual REITs, you can decide which REITs you want to buy, and then you potentially can get higher returns if you are able to choose the right REITs, right? So then you're positioned for higher returns compared to a benchmark or an index, which gives you an average across different REITs. Obviously, also, there is no management fee because you are doing your own research. There is no management fee that you need to then incur when you're buying individual REITs. However, obviously, there are issues when it comes to taking exposure to individual REITs, right? Like, it needs a lot of time commitment, a lot of research in terms of analyzing the different REIT subsectors, their impacts, like macro as well as fundamental. There are things in terms of diversification that you typically give up because you will not be able to diversify to the same extent that an index will be able to do. So there is definitely higher risk, higher drawdowns, potentially. You need to rebalance and manage it by yourself. There are brokerage costs involved. So in Singapore, obviously the brokerage costs are still pretty substantial. So especially if you're trading through banks, et cetera, it can be as high as 0.2% or more. And then there are some other hygiene stuff, like dividends, et cetera. Those things you need to reinvest yourself. And especially what I think the challenge is, if you are investing smaller quantities, the dividends are not big enough for you to make the lot size of the individual REIT investment in the same proportion that you have for your individual positions. Similarly, right subscriptions, et cetera, you have to take care of all of these yourself. Now, obviously, it is also not very easy to pick REITs. So if you look at a broad-based index such as, say, IEDGE S-REIT Leaders Index, this year down 11.6%. Again, this is June data. We've seen a sharp kind of rise up into the REITs market as soon as we got more certainty into the interest rate outlook over the last couple of weeks. But if you were to look at some of the top 5 REITs which retail investors have put money in 2023, these are the top 5 REITs. Now, maybe with a quick show of hands, how many of you think that more than 3 of these REITs have outperformed the index year-to-date basis? Okay, very few. The answer is correct. So if you look at the REITs, essentially only 2 of them have done better than the index, and it is not by a huge margin, right? So Suntec down 12.1%, Mapletree 19.6%, and then I think look at the bottom, 45% down on the prime US REIT. And this is the point, right? Like, when you're trying to take exposure yourself, you're always exposed to these idiosyncratic risks versus like, where you're investing into a broad-based index. And the index is designed to keep the best performing REITs and REITs that are continuously adding market cap within the index. So it is kind of self-cleansing in nature. It does the management automatically because REITs that are not performing well will continue getting out of the index. So by the nature of you investing into the index, you are investing into the best REITs in the market. And that's why it is pretty hard for individual investors to beat the index in the first place. So now coming to ETFs, right? So if you want to address that, obviously you can look at REIT ETFs because that way you get instant diversification. It is much less volatile compared to individual REITs. They are rebalanced periodically, as I said, right? Like, lower performing REITs will kind of like get filtered out as time progresses. And you don't need to put a lot of time and effort because there is no need for you to then research individually. What do you give up in exchange? You obviously give up a little bit of control. You can't determine, if you don't like a certain REIT subsector, there is no choice, right? Like, you have to take that exposure in a broad-based manner. There is ETF management fee, so you need to, pay management fee. There is brokerage costs, and then still the dividends are not automatically reinvested. So this is where potentially Syfe REIT Plus could be a strategy that you could look at, and I'm sure a lot of you have actually invested into the Syfe REIT Plus portfolio. The Syfe REIT Plus portfolio actually helps you gain access to the largest and the most tradable REITs in the Singapore market. And it is a portfolio which is, I think, the first investment offering to closely replicate the performance of the IEDGE S-REIT Leaders Index, right? And I will talk a little bit more about the IEDGE S-REIT Leaders Index, but more importantly, the Syfe REIT Plus portfolio is just a better way for you to invest into the REITs market. The reason I say that is it has got all the characteristics of the ETFs that you invest in, but with added efficiencies and optimizations built in. So with the Syfe REIT Plus portfolio, you can still invest into the largest market cap REITs in the market. So these are all the blue chip REITs. And Amelia was sharing earlier as well, like, the blue chip REITs are all trading below their price to book ratio. So actually, by investing into this particular portfolio, you are actually getting exposure to some of the largest blue chip names as well. And they're all backed by reputable management teams. The cool thing about our portfolio are things like auto dividend reinvestment, right? Like, this is something that is automatically done for you. You can also choose to get the dividends paid out to your bank account if you choose so. And then more importantly, there is no minimum, right? So with, again, individual REITs, you're subject to lot sizes, et cetera. If dividends are not enough, you cannot invest back into those REITs in the same proportion. All of those issues are sorted because there is no minimum on our side. You can fractionally invest into REITs. There is no brokerage costs, so we absorb all brokerage costs. This is something, again, very special for our REIT Plus portfolio versus when you trade ETFs, then you do incur brokerage costs, et cetera. And our management fee is very, very low as well. So a little bit about the Syfe Leaders Index. As I shared earlier, this is an index created by SGX. So we partnered with SGX to launch this particular portfolio. This is the first portfolio that tracks this particular index. And again, our view was that we want to get exposure to the most liquid names in the market and the most blue chip names in the market. It has got a strong capital appreciation and attractive dividend yield of 6% plus. And there are, again, from an optimization standpoint, there are screenings that are done in terms of free float, velocity, and each REIT exposure is capped to 10%. So if the portfolio has, say 20 REITs, each REIT will not have more than 10% exposure per se in the portfolio. In terms of the breakdown, again, fairly diversified, so it is not just concentrated in just one of the few subsegments. It is diversified across industrial, retail, office, but also data center, logistics, and healthcare. In terms of geographical diversification as well, obviously predominantly Singapore, but also got some regional allocations and all as well. You can see that there is some China allocation, there is some US allocation. This is more on the index level, and this is where we have further optimizations built into our portfolio where our exposure to the US market is much lower compared to the index itself. These are the top 10 constituents. Again, you can see that these are very familiar names for you. And again, the exposures are across the different REIT subsegments as well. In terms of our selection criteria, the Syfe REIT Plus portfolio incorporates a lot of the filtering criteria that are present within the iEdge S-REIT Leaders Index. So our portfolio is designed to track the index, but at the same time, we have a couple of additional optimizations which has significantly helped us in terms of doing better than the index over the course of the launch of the portfolio. So our portfolio is only Sing dollar denominated REITs, so we do not take exposure to non-Sing dollar denominated REITs, which again helps from a standpoint that there is less FX risk and there is also less global risks per se into the portfolio. Plus, the liquidity screenings are a little bit more tight. So the index has around 22 names. Our portfolio limits it to the top 20 names. And then, of course, it is rebalanced semi-annually and reviewed regularly as well. There are two choices available for investors when it comes to the Syfe REIT Plus portfolio. There is the 100% REIT portfolio. So if you want to get a dedicated exposure to all the REITs in the iEdge S-REIT Leaders Index, then you can take the 100% REIT portfolio. Or if you are a little bit more risk averse, then you have the choice to go for our risk managed REIT portfolio, which combines the REITs with Singapore government bonds. So that really helps when markets are uncertain and there are sharp corrections, et cetera. It helps you cushion against those downturns. But of course, in return, you have to give up a little bit of the dividend yield, et cetera, for the risk managed solution. Now, quickly comparing the REIT portfolio against, say, DIY investing, right? So obviously, when you're investing into the Syfe REIT Plus portfolio, you do give up a little bit of control because you have to follow our strategy. But again, as I highlighted earlier, there is no minimum investment for you. There is no need for you to create a CDP or a brokerage account. Brokerage fees are fully absorbed by us. Dividends can be automatically reinvested. Rebalancing is done by us. Right subscription handled by us. And it all is done at a small subscription fee or a management fee of between 0.25 to 0.65%. In fact, just the point of the auto dividend reinvestment, because the REIT dividend is close to 6%, that actually adds, and the return of it is substantial enough to kind of cover the management fee that you pay. So in a way, this is like a self-paying strategy compared to investing into other vehicles per se. Similarly, comparing against the ETFs, again, one of the key aspects is auto dividend reinvestment, right? Like, it is something that is automatically done for you. Our portfolio tracks the index much more closely as well because we take exposure directly to the underlying REITs. There is no overheads involved, etc. Again, brokerage costs and transaction fees are borne by us. This is something, again, you need to incur if you are buying into ETFs, etc. And liquidity, all of those aspects are taken care as well. And we are, I think, the only portfolio or a solution which gives a quarterly payout of dividends. All other solutions in the market, I think, are mostly semi-annual or even longer. Some of the actual names as well, like, you can see the exact number of REIT constituents, the actual management fee, so you can compare how our management fee compares against some of the ETFs. But I think, again, on top of it, the fact that there is no brokerage transaction fees, dividends getting reinvested automatically, all of that kind of adds up. The dividend yield is slightly lower compared to the other two, but one key point there is we never pay dividends out of the capital, right? There are some of these ETFs which can pay dividends from their capital, and they try to maintain the dividend yield at a certain level so that on a headline basis it looks good. But we are very sure that we don't want to touch the capital when it comes to the dividends that are generated for you. And in terms of returns, as you can see, the REIT portfolio has consistently outperformed the benchmark index, which is the iEdge S-REIT Leaders Index. And again, the product is actually designed to track the index. And the only reason it has been outperforming is, number one, because of the extra efficiencies that we have put in with respect to liquidity checks, plus the fact that we do not have the USD REIT exposures, which had a particularly bad time over the last couple of years and all. And even if you compare against some of the peers, you can see that the Syfe REIT Plus portfolio has consistently done well. Obviously, the overall REIT market has, could do better. And this is what I think is the interesting bit at this juncture, because the yields are at a 5-year high, right? Like the price to book ratios that Emilia was talking about is, at 0.8 levels, which is much, much lower compared to, the historical average. And if you look at the recent price action of the S-REITs market, this is where things become very, very interesting. As soon as we got a little bit more clarity that the interest rate cuts are actually going to happen, and the market is now pricing almost 100% chance of the September rate cut to actually take place. As soon as that news came out, you saw that the S-REITs market did a pretty hefty bounce back. It jumped by 7% just in a couple of days. And this is where I think we are poised for a recovery, and hopefully the patience that all of us have placed in the REITs market will bear fruit as we move forward as well. So with that, I guess, yes, I think before I close, obviously in terms of investing, we want to give you all the control. So on Syfe side, we have a platform where you can invest into the REITs market. If you are a DIY investor, we have our brokerage platform. So you can invest into individual REITs or ETFs through our brokerage platform. And again, our fees are very, very competitive in that regard as well. And of course, our Syfe REIT Plus portfolio is available on our managed side of the solutions as well. There is also cool features because we have cash management solutions. So if you want to DCA into the REITs market, what you can do, you can put money into our Cash Plus Flexi portfolio. And there right now, we have a product with Lion Global, which yields 3.7%. So as the interest rates start to come off, and even in Singapore, that will happen, there is a reinvestment risk that you entail with your cash holdings. So if you have cash, you can easily park it somewhere like a cash management solution like Syfe Cash Plus and do a DCA into the REITs portfolio and automate your investment and entry points into the REITs market as well. So very cool in terms of the overall REIT platform, the overall Syfe platform that you have and how you can automate your investment into the broader REIT market. With that, I'll take a pause and we will move on to the Q&A section. Thank you.
All right, thank you very much, Ritesh. May I invite Toche and Emilia up on stage for the next part? So while the speakers are getting ready, if I can invite everyone once again to take out your mobile phones, scan the QR code. If you're online, feel free to do the same. Right, there is a mid-session poll where I would like to invite you guys to actually answer one simple question. Right, Amanda, if I can have the poll results for the earlier one. Yes, so earlier, before we started this evening's session, we actually asked everyone on stage and online, what do you think the S-REITs markets will be performing in the next 12 months? And we see a pretty high positive reply, even now it's still moving, right? Okay, if you are looking at this right now, you should be looking at a mid-session poll, right? This is the pre-session poll. All right, so anyway, 63% was positive, 27% was neutral, and only 9% was negative. Right, the next question, please. All right, and which asset classes do you think will be performing the best in the next 12 months as well? And 55% of you replied equities, followed by REITs, bonds, and gold, and finally cash as well. So very low at 1.4%. Right, and now at the mid-session poll, let's see if the speakers have managed to sway you guys a little bit. Right, and we have 84.5% positive, and it's moving up as well, slightly. Right, with 12% neutral and the last negative at 1.9%. All right, so I guess great job to the speakers. I'll pass the time over to Ritesh. Ritesh, please.
Thanks, Jason. All right, we'll start off with a few questions that have already come in. I think there are a bunch of them already, and you guys can all vote for the questions as well. So if you have not yet taken a look at the QR code, please do scan it and post your questions as well. Let's look at I think this one is interesting. Let's start with this. I started investing in mid-2021, and my portfolio is down 10% now. What are the major reasons for these? What do you think is the timeline for profitability or for this portfolio? I can take a stab at it, but maybe before I do that, Amelia, do you want to just quickly cover how the REIT market has evolved over the last couple of years, and how should this investor look at the REIT market going forward?
Definitely. So I'm trying to look at the questions. Okay, this investor, you started investing in mid-2021, portfolio is down 10%. I'm guessing you're referring to REITs for your portfolio, right? So we were looking, we're talking about interest rates just now, and what happened with the interest rates side of things is that rates have been rising, right, since 2022 all the way until now. So yes, that definitely has some impact onto the REIT market. But for this particular investor, one thing to note is that investing, especially for REITs as well, it will be good to sort of, normally I see it as a long-term kind of investing, like taking a long-term view, right? And for REITs, pre-COVID, if you look at the 10-year returns, the returns for REITs closer to, in fact, I think more than 10% on a total return basis. So REITs I think since the IHS REIT Leaders Index, we have the numbers from, I think, 2010 all the way until now, right? So typically, I think what I'm trying to say is that for investing, it's good to keep a long-term horizon. Yes, during the mid-2021, which has a mix of COVID impact as well as the interest rate impacts, markets across the board, it's been a challenging environment. Even for companies that are operating, even for private companies, it's also been challenging, right? Throughout 2022, tech stocks have also taken a hit, which is also why the STI during 2022 has outperformed the global markets. STI during that year, I think we were up about 8 to 9%, largely driven by the banks, right? And tech, some of the other tech sort of related indices have taken a bit of a hit during that period. So for investing, it's important to sort of keep a long-term mindset, because when you're investing into REITs, it's a little bit of your, bit of a wealth accumulation where you park a bit of money, like what Rita's mentioned, see it as like a DCA product where every month you save $500 and the $500 goes into investing into the REIT Plus portfolio. Dividends are then reinvested. So over time, you're looking at it from a total return standpoint. Yes, there could be some investors that are more tactical, right? Taking opportunities within the particular sector to say like, okay, maybe there are certain trading ranges. But for investors that are looking longer term, that is where for REITs, you look at it from a total return standpoint, longer term returns. And if we do believe in terms of the global macro, and if we believe sort of where the interest rates will be, looking at the Fed expectations using the CME Fed Watch tool, analysts are also expecting rate cuts. I think, Toche, you also mentioned, right, this year we're looking at potentially up to 50 bips in terms of the cuts at the end of 2024. So if we're looking at that kind of environment towards the end of this year and also next year, a lot of the institutional investors as well as the analysts, they believe that the moment sort of Fed starts to indicate or do the actual rate cut, we could see even insti funds coming back into this sector, and many of them have actually net sold the sector over the last few years because of the current environment.
Thanks, Amelia. And I think just to add on, as Amelia mentioned, right, like, obviously it's been challenging over the last 2 years. So if you came in 2021, it was really the peak of the market, right? Like, it was the post-COVID rally, and a lot of us got swayed into that rally and we wanted to catch the momentum. But as soon as, like, we started investing during that period, you only saw the downturn, right? So 2022 was the period through which you had to go through. And if you actually did not DCA, I'm not sure if the person DCA'd during that time or not, that is a key aspect of, getting exposure to some of these specific asset classes. And, at the end of the day, it is a specific asset class and it is specific, market that you're predominantly taking exposure to and all as well. So I think it is important to have that, have that perspective of investing regularly through this period of downturn. And as Amelia mentioned as well, historically, REITs are positioned to give you both the dividend yield and the growth. So typically, my long-term view is that REITs should be able to deliver you around 5-6% of dividend yield. And then on top of that, a growth which is approximately like 3 to 4% as well. So that should be an ideal situation. Of course, the high interest rate environment is not conducive to it. And that's where I think right now, if you look at the market and the projections that we have, it is potentially a turning point, right? So I would say you have been patient for a very long time. Stay a bit more patient, wait for another year. If possible, I think still very good entry points to enter into the REIT market before that bounce back happens. So you could, average out some of your positions. That is one way to do it. And I think overall, also look at your, overall strategy of investment into income as a whole. So if you're overly concentrated in REITs, so try to diversify from that perspective as well. And that's what, the platform allows you to do when, you're not just subjected to one of your investments not doing well, and then that basically impacting your overall, wealth journey. Make sure that you're diversified in general as well. Let's take the next one. I think there was one around the Trump re-election as US president and his expansionary fiscal policies. Do you think this will actually lead to interest rates staying higher for longer? And, Toche, you alluded to this a little bit in terms of how this can impact the longer end of the curve. Of course, the shorter end, we are a little bit more certain that there will be a few cuts going into the end of the year. But as, these things pan out, if there is a re-election, what do you think will happen more broadly across asset classes?
Right. I'll break the answer into two parts. The short end and the long end. Now, on the long end of the curve, so I mentioned that if we do get a clean sweep by the Republicans, Trump will be having his policies, right? Tax cuts, tariffs, immigration, especially fiscal policies, and these are all inflationary. The market, if this does come to pass, markets will react, and the long end of the curve would then go up. Now, I did mention that we need to put things in context. It's not going to keep going up. The magnitude we think is around 25 to maybe 70 basis points, right? So remember, I showed the comparison of how much rates went up from 21 to now, and this is to give you the context of the magnitude of move. Now, we can only kind of estimate this amount when he comes in, and after that, you have so many other things happening, right? If you have a tariff war with China, what if you have a global recession? Then you have so many other permutations, which It's very hard to think about. The short end of the curve, meaning 3 years, from 0 to 3 years, this is the part that's very correlated to Fed's action. And as I said, Fed is on track to cut twice this year, 3 to 4 times next year. From now to end of the year, they are likely to go ahead. They are not affected by the precedent, right? Because Trump is not in yet. And of course, it's not given that Trump will come in. Now, if it does come in, the question is at that point in time, what happens? What is this dynamic between Fed and the president? Fed is, like I said, supposed to be independent. Question is, will they try to preempt Fed's policy, right? If they do, then they are unlikely to cut as much as what market is expecting them to cut today, right? Remember, market expecting to cut 2 this year, 3 to 4 times next year. So the 2 is given in a sense they will not be interfered by the president. The 3 to 4 next year, that is the question. It's either they get interfered by the president. Remember, Trump can say things which makes things difficult for the Fed, or the Fed might want to preempt what Trump's policies will do to the economy, right? And therefore, they might not cut as much. So on that front, that's negative for interest rates, meaning the rates could go up, or rather will not come down as much as what market expect.
Any views on asset classes on the back of that?
Asset classes, okay, so we call this a Trump trade, right? And this happened in the last 1.5 weeks. So in a Trump trade, equities will go up because Trump is a businessman. He's very pro-business. He's going to cut taxes, which is good for businesses. He doesn't like regulation. He likes to deregulate. So that's in general good for equities. But of course, you need to watch out for sectors, right? Sectors that's exposed to foreign sales. Sectors that's exposed to China, that's negative because of tariffs. Of course, you can go down to a lot more things like oil, environment, and all that. For bonds, that's going to be bad, right? In this environment when you have a clean sweep. I think these are the 2 main things. Yeah.
Thanks, Joche. Let's move on to the next one. If we can go back to the Q&A screen, please. I think this one is an interesting part of S-REITs have attractive valuations, but are there any fundamental reasons why their valuations can remain low? So, is this a value trap, Emilia?
Okay. We talked about earlier on, okay, so you mentioned that S-REITs have attractive valuations, but any fundamental reasons why valuations are remaining low, right? Interest rates was something that we talked about earlier on. And I also mentioned that interest rates can impact the sector in 3 ways, right? One is financing costs. Things become more expensive, cost of debt also increases, and that could potentially erode the distributions that the REITs will pay out to the shareholders or the unit holders. And the third one is also property valuations, right? That could also impact, and which is why in the last, I guess, 1-2 years or so, we see a lot of investors switching out to some of the sort of safer instruments, investors investing into buying T-bills and all that, right? Because your interest rates are so high. But when we take a look at this particular sector, right, we talked about valuations, price-to-book ratio is currently trading at about 0.7 to 0.8 times, which is at a discount against its historical average, trading at 16 to 20% discounts. So in terms of investors, right, when you're sort of looking at this sector, it's important to sort of adopt a view, right? Like, what is your view? If you think that macro, things are going to change, then perhaps now could be a time where you might want to then see this point in time as an opportunity. And perhaps that is why we're seeing a lot of investors pouring a lot of funds back into into this particular sector, right? Retail funds coming into this sector in this first half of the year alone, 6 months worth. Net retail has bought in about $1 billion worth of this sector, and this is probably triple or double that of what we're seeing in 2022 and 2023. Of course, when you talk about valuations, right, as a sector as a whole, then you break down into inside the sector, within the property segments and within the individual REITs. The valuations vary, of course, especially when you're comparing REITs with different property subsegments, REITs that are invested into different property markets, of course. But that's one point that I wanted to bring across tonight, which is the point of diversification, right? Because when it comes to investing into REITs as a sector, like Rita's mentioned, there are a few ways that you can go about that. One is to invest directly into individual REITs, picking the sector or that particular REIT that you feel, okay, I want to invest in this REIT because I want to get exposure into a particular asset class, a particular segment of the market. But when you think about investing, diversification is important because when you diversify, it's sort of like, very easily what we always say, right? Not putting all your eggs into one basket. Right? And diversification helps to also have that kind of resilience factor, right? Because when you're investing into a particular REIT, it depends on where the REIT will or it's like investing into a particular stock. How that stock will perform will depend on that single stock. But if you invest into a basket of REITs, in this case, which is the IHS REIT Leaders Index, there's instant diversification into almost 20 plus of your REITs already. And which is why also investing into REITs not just gives you that kind of diversification into the different markets, into the different subsegments. REIT managers themselves, when they buy or manage a REIT portfolio, they don't just manage a portfolio with just one or two properties. They invest into a portfolio of multiple properties also because at the REIT manager level, diversification is important because they're not just diversifying into different sub-segments that they have the mandate in. They're not just diversifying into the different markets. They're also diversifying across different currencies. And I think interest rates is one that has affected the sector quite a fair bit recently. Not just interest rates. There's one more thing that kind of affects the sector too, which is FX. SGD has strengthened against some of the regional currencies, and that also has a bit of an impact on distributions because, for example, right, if you have, let's say you invest in overseas properties and you receive rental income in that local currency, and when you convert that, if Sing dollar against that has been quite strong, your returns will also then be a little bit smaller. So that is the point of diversification over here that I wanted to sort of bring across.
Thanks, Amelia. And just to add on, I think like the fact that people are questioning the fundamentals of REITs, I think it is obviously also, an effect of the macro environment fundamentally. A big component of it has been, the interest rate environment. And that's where I think the thesis changes as we look forward, that if interest rates are going to come down, there is definitely a lot of positivity that you can expect on the REITs market. And some of that you already saw with, the last couple of weeks price actions per se. So again, I think, yes, there are reasons why the valuations have remained subdued because the cost of capital has gone up, and that has impacted like the bottom line of REITs and their ability to kind of like, keep, acquiring new assets, etc. and all as well. But as we look forward, as these things roll over, I think, Amelia, you also mentioned that there is still so much headroom for the gearing ratios of some of these REITs to, pan out. And I believe like as interest rates normalize, they will be, a slightly more aggressive as well in terms of pursuing these opportunities, which they must have been like holding back till now.
Actually, Ritesh mentioned about the gearing ratio. There's something that right after my presentation, I saw the latest updates from the MAS. So, S-REITs as a sector in Singapore, this particular product is governed by the CIS, which is the Collective Investment Scheme. Government has been very supportive of this sector. There are a few things that the government has put out. Number one, we talked about tax transparency. So REITs, every $100 that they make, $90 go back to unit holders. They don't have to pay tax. The tax is at the investor level. But for all individual investors like ourselves, the dividend withholding tax is actually tax exempt, right? So what happened during COVID is that MAS actually sort of loosened they loosened the debt headroom. They actually increased the leverage ratio. Previously was lower. Now it's actually up to 50%. But up to 50%, only assuming that the interest coverage ratio is at least 2.5%. This evening, MAS has actually announced that they are doing a proposal or a consultation. They're proposing to relax the leverage requirements for S-REITs, meaning to say that the S-REITs can increase their leverage limit up to 50%, but at a lower interest coverage ratio of 1.5 times instead of 2.5 times. So you can see that in terms of regulations, they are also supportive of the sector to allow a little bit more of a breathing room for the REITs also. Because I think with the current environment and all that, it has been a little bit punishing for the sector. Yeah, so just fresh off the news, I thought good to share and touch a little bit about this point with everybody.
Thanks, Amelia. Let's look at the next one. I think we'll cover the subsector a little bit later. I guess this one question about the residential market having slowed down, and especially on the rentals, do you think it will start impacting on the commercial side as well?
Residential market started to slow down.
In terms of at least the rentals have
Okay.
started to come off a little bit.
Okay.
Do you think like the rental revisions that some of these REITs have, do you think that will get impacted on the commercial side as well?
To make things a bit fun, I think yesterday we all saw the news about this HDB transaction that actually hit record high, 1.73 million, is it, for that particular flat? So question, okay, is residential market slowing down? I don't know. There's still this kind of news. $1 million HDB flats are still hitting the news, right? Separately, we look at the commercial market. Number one, not everybody can directly invest into commercial real estate so easily, right? Private real estate, yes, because everybody needs a roof over their heads, okay? But for commercial real estate, access into that for investors, not so straightforward, because you have to have higher capital outlays, right? You buy a physical asset, it may not be as easy to transact, liquidity may not be there. So REITs is definitely one way for you to gain exposure into some of these commercial real estates. But if we break down into the different subsegments, I think if you, when we take a look at the different property subsegments like hospitality REITs, retail REITs, office REITs, data center REITs, healthcare REITs, so on and so forth, they each have their own story. Hospitality REITs, for example, we took a look at that in one of our pieces that we put out a few weeks ago. The hospitality REITs, when they look at rental income, they look at it in the form of revenue per available room, which is RevPAR. And this RevPAR has actually exceeded pre-COVID levels. So a lot of our REITs have seen, because of the return of air travel, tourism coming back, China, Singapore, there's the visa-free travel. We're seeing a lot of these tourists sort of visiting Singapore, and that has been somewhat a beneficiary for the hospitality REIT segment, okay? For example, if you look at retail REITs also, maybe on the weekends, you might visit some of our local malls, Vivo City, Suntec City, so on and so forth. What's the common trend on the weekends? Wow, very crowded, right? And some of the retail REITs, they have reported also over the last business updates earnings season, the tenant sales and the shopper traffic has exceeded pre-COVID levels. So it's good to see that some of their operating metrics are quite positive, showing that perhaps there are bright spots within the marketplace. For office REITs, things have been a little bit soft so far because demand has been somewhat soft. Supply side of things, also relatively low supply. But some of the analysts do believe that for office REITs, the rental reversion so far has been a little bit positive because when we look at some of the lease renewals this period, a lot of the expiring rents were signed during COVID period. And during COVID period, the rents were a lot lower. So as they do the revisions, I think some of the analysts expect this space to see positive rental reversion. And for example, another sector, data center. Data center, some of them see it as an essential segment nowadays. Why? Generative AI, cloud computing solutions. Nowadays, when you see the news about NVIDIA and all that, right? Gen AI and AI is very real. And what do they need? They need data. And what does data sort of run on? data centers. So perhaps a reason why, for example, some of our data center REITs, Digital Core REIT, was the best performing in 2023. Right? So when you look at the different subsegments, what I would say is, as an investor, it depends on what you sort of believe will be a potential over the next year. If you think that, okay, data center REITs, or rather AI is, you're positive on that as a particular sector, you could look at REITs that give you that kind of exposure. If you feel that retail, domestic demand is coming back with some of the tourist arrivals also coming in, then you could see to get exposure into some of these segments. But coming back to this particular question, will it impact commercial side? I hope that gives you some little nuggets in terms of how the commercial side of things will look going forward. And as with, REIT investing and all that, you don't have to pay ABSD as opposed to buying a second property just to get your rental income. Right, which is why I think Rita mentioned earlier on, yes, I do love real estate, but to get that kind of exposure, REITs will give you that kind of exposure into real estate properties, also for you to receive that kind of rental income in the form of dividends, and for you to also gain that kind of capital gains if the price performs as well.
Maybe can I just add something here? So from our point of view, we do invest into bonds issued by REITs. So we look at REITs from a credit point of view, and obviously credit risk is very critical. So this question is about whether commercial rental would come down similar to what you see in the residential market. Now, if you think about it, residential rental market post-COVID went up, and now it's coming down. So why did it go up in the first place? Because post-COVID, or rather, that during COVID, construction stopped, right? So supply dropped. And then when economies open, people come in, you have demand exceeding supply by a lot more. So we've seen rental of residential units going up as much as, I think, 50%, right? There's some overshoot there, and then it came back down. Commercial, you don't have this kind of problem, right? You're not so dependent on building commercial spaces to let people come in. The one thing I need to highlight is a lot of time people point to the US commercial market and say, oh no, is that going to happen in Singapore? So I work in an office building. My desktop is still there. The company is not going to take away my desktop. We do have hybrid working arrangement, but the company is not going to downsize our office. This is very different from the US, right? In the US, you do see companies downsizing. So you do hear about commercial real estate deals or prices getting cuts. So cap rates have gone up in the US. In Singapore, you don't quite see that. Perhaps because, well, it's not just Singapore, in Asia, right? Asians, we are more compliant. Right? You listen to our bosses, you don't try to revolt. The boss say, come back to the office, you say, yes, sir. You don't ask why. So commercial real estate in Singapore is not that badly affected. Of course, you do hear about spaces being empty, potential softening, but not to the magnitude that you're seeing in the US. That's for commercial. Now, the malls that you visit, right? I mean, you know the crowds you see at weekends. And this is kind of in line with inflation. Unfortunately, we all have to face the fact that things are now more expensive. So my kopi siutai is now 150 instead of 120 before COVID. Your zhai fan is more expensive. Prices aren't going to come down. And in line with everything that's going up, rentals have gone up, even in the commercial space. Is it going to come down? Unlikely, unless you see huge oversupply, and we don't quite see that, at least not in Singapore. So from where we see commercial real estates, we do think that the cap rates or other prices will be stable. So from that point of view, we don't see a big risk, at least from the credit side of things in the REITs market.
Thanks, Amelia and Toche. Let's see if we can address a couple of questions quickly. I'm conscious of the time. So I guess let's start with a little bit on the macro front again. Let's take maybe a stab of a couple of them, at one go. So number one, the S-REIT dependency on the US interest rates. and expected impact of S-REITs due to forex moves if SGD were to strengthen against these local market currencies. And Emilia, I think you mentioned a little bit on that front as well. But I think like going back to coverage that you had provided earlier on the interest rate outlook, and then its impact on the Singapore interest rate, and then the further impact on the S-REITs market. Maybe like we can do a quick summary of those points and on the forex as well, and then we can maybe wrap it up with that topic. So let's first address this.
Yeah, maybe a quick mention on the FX. Again, from a credit risk perspective, a lot of the REITs, they hedge their FX naturally through borrowings, right? So imagine if a REIT were to buy into, let's say, a Japanese assets, they would borrow in yen because the assets are in yen. So that forms a natural hedge. When they say borrow, they could either borrow from the bank or they could issue a bond denominated in yen. So that provides the natural hedge. It's not always 100%, but it does reduce the FX exposure by quite a bit. On top of that, they would hedge part of the DPU such that, for the next X number of months, they can confidently pay out the DPU without, taking the swings from the FX. On interest rates, I think I've covered. Sing interest rate follows US with that differential, right? In terms of correlation, it's probably 80–90%. In terms of absolute levels, I mentioned it is lower, but it does mean that if rates were to come down in the US, Sing will follow, although not one-to-one.
Thanks. Emilia, anything you want to add?
No, I think maybe we can move to the next
Sure.
percent of time. Yeah.
All right. I think we can go back to a little bit in terms of, what role does a REIT play in an investor portfolio, right? And, how can, I think if you go down a little bit, what the primary risks associated with investing in REITs, how can investor effectively mitigate these risks while balancing the potential for income and capital appreciation, right? So I think this is, very important in the context of what role does REITs play in your portfolio? How do you, use it, whether on the growth side or on the income side? So maybe, Emilia, if you want to quickly take that on.
Two ways I see it. One is asset allocation, right? Our portfolio, when we think of a portfolio, normally you have a mix of things. Cash, bonds, equities, so on and so forth. REITs, like what I mentioned earlier on, for insti investors, they see it as a big, important chunk of their portfolio when it comes to asset allocation, because REITs give you that kind of payouts. It's a bit like a bond where it gives you regular distributions, but it trades like a stock. So it's quite unique in terms of like an asset class, if you will. And personally, I feel that it's for the long term. Personally, my own sort of portfolio, REITs are quite a significant portion of it, maybe because I love real estate, right? But number one, asset allocation. Number two is the exposure that you get through investing into REITs, right? Like I mentioned earlier on, if you want to invest in data centers, you're not going to buy a data center tomorrow. You want to invest in hospitality assets, you're not going to buy a hotel, right? Or if you think, okay, for certain markets like Japan, right, aging population and all that, there's a lot of room for you to get exposure into the nursing homes or the retirement homes over there. Not easy for us to also go there and just buy a nursing home, right? But through the different REITs and the different investment mandates that you have, as a retail investor, you can get exposure into, number one, different markets across the board, not just Singapore, but also overseas markets, and some of these emerging markets also. For sectors, for example, getting exposure into data center, getting exposure into industrial, logistics, properties, that is the kind of exposure that you can get. So two things really, when you're talking about that, would be asset allocation and also the diversification in terms of the various sub-segments and also geographies that you can get while investing into REITs.
So basically, the first thing is, within REITs, have diversification. So that's one way to mitigate the risks. The second is at the other end, overall asset allocation, right? Like, how are you thinking about REITs in your portfolio, whether it is on the growth front or on an income standpoint? Don't make it the only portion per se, right? Like, have a diversified portfolio. If you are looking at growth, have equities as a base, like add REITs to supplement it, but don't, predominantly make it a REITs only portfolio. Similarly, if you are looking at income, have bonds as one of the bases, and then, add on the REITs as well. So that ways you diversify more broadly, and then you still get the benefits of these subsectors as well, right? So I think those are two very important points when it comes to investing into REITs, the broader asset allocation, and then within REITs, if you're stock picking, there are even greater risks involved, right? So make sure that if you have a view, yes, take those views, all of that is good, but that should then be another satellite to your overall REIT strategy, right? So have a broad-based allocation on REITs, say from a Syfe REIT plus portfolio or the ETFs, and then add on the single stock exposures as well, right? So I think that's how I would think about it.
One other thing also, forgot to mention earlier on, is that REITs are also professionally managed. They have a REIT manager that will actually manage the portfolio, literally the REIT assets, right? And these REIT managers are in charge of a few things. They have to take care of the unit holders, right? So there are a few ways that you see REITs trying to increase their DPU. Number one, maybe through acquisitions. They buy more, and some of these acquisitions are also DPU accretive, means it will sort of build towards increasing the DPU for the unit holders. Number two, they also manage the properties. Asset enhancement initiatives. Sometimes when you visit the malls, they're undergoing renovation or touch-ups for certain buildings. The whole point of asset enhancement initiatives is to also make the asset a bit more attractive, so that rental reversion, when they renew the lease, it could also be positive for investors. For example, VivoCity, right? One of the basement floors, they recently did an expansion. They increased the number of floor area for VivoCity as a whole. And I think the REIT in the last earnings update announced that the ROI for that asset enhancement initiative has already broken even. And in fact, it's even that they're raking in some of the positives from that. So asset enhancement initiatives are also important. The way the REIT manages the asset is important. The kind of tenants that the REIT also attracts is also important. The REIT manager also then manages their occupancy levels, tenant renewals. Those are all left to the REIT manager that is supposed to professionally run the REIT. So that will then help to sort of give unit holders a little bit more of a peace of mind, such that you know that the properties that you invested in are professionally managed. So that is one in terms of mitigating a risk in a way when you're investing into these properties.
Thanks, Amelia. Okay, last question. Any favorite REITs or REIT subsectors, both of you?
Personally, I like the local commercial meaning the shopping malls. Local as in because, I mean, you look at REITs that went overseas, some of them didn't do well, right? China exposure, they took a hit. In Singapore, you are familiar with the shopping mall. You can go around, you can visit VivoCity and look at how crowded they are. That gives me some sense of comfort. And you kind of know when things, at least you know when you lose money, when things go wrong, you know why it goes wrong, right? So that's something that I get comfort in. Yeah.
Me, okay. I would prefer not to do individual stock picking because it's just more convenient for me to buy into a basket of REITs. So which is why I would look at something like the REIT Plus portfolio, as in I'm not selling Koyok because we're here, but literally it's convenient, right? You don't have to keep track of the different REITs, how are they doing, things like that. You're buying into immediately a basket of diversified REITs, and then you get that kind of instant diversification. Yes, you can also stock pick, like I mentioned, if you feel that there are particular sectors that you look forward to for next year. For example, if you think healthcare is potentially going to be a always resilient, evergreen topic, right? Stable or that, okay, you can look at those related assets. If you think AI, tech is something that is a big growth over the next few years because they say data center has the potential to grow at a CAGR of, I think, up to 20% over the next 5 years. You could look at that. Right? Or if you feel that you're really seeing tourists coming into Singapore, wow, malls are getting crowded, hotels are getting more expensive, you could then also look at various subsegments. But for those that don't like to stock pick, one, the convenience want to just sort of buy something and it's instantly diversified, you can look at the any product that sort of tracks the index, and that tracks immediately a basket of REITs that invest in directly.
Thanks, Amelia. And just to close again, I'm clearly biased, so obviously I will recommend the Syfe REIT Plus portfolio. But just to close this off, obviously, diversification is the only free lunch left, right? So you could pick your own REITs and look, on our platform as well, you do have that opportunity to trade through our brokerage platform, and we make it very easy and accessible and low cost. So if you do have views, do express it through the brokerage platform. But I think if you're trying to invest for the long term, always have a more diversified strategy to begin with. So with that, I'll close the Q&A session today. Thanks, Toche and Amelia, for the various insights that you guys provided.
Thank you.
I will hand it over to Jason for the closing. Thank you.
Right, let's give a round of applause to all our speakers, please. All right, so we'll just pause at this screen as the last slide of this evening's session. Syfe has happily celebrated our 5th year anniversary this month, July, right? And we actually have a promo code Syfe5. So if you're not aware of it, just head over to our website for more details and more information as well. All right, just a few closing remarks. If you do have questions, please feel free to submit it online. We will still keep it open, right? Of course, the advisory team is also available. Feel free to reach out to them one-on-one basis as well. All right, with that, I'd just like to personally thank the online participants for joining us this evening. For those physical, I won't hold you back from your refreshments and networking. Thank you very much. Thank you.